Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. And I'm going to get into some Q&A in this episode. And just a reminder, if you have any questions or feedback, you can send them to me by email at questions@investopoly.com. And the first question is from Ryan, and it's relatively similar to a question I answered last week in last week's Q&A episode, although there's a little bit of a difference, I guess, in terms of the question. So I think there's something in it for hopefully most listeners. Ryan asks, there's quite a bit of a preamble and question, but essentially Ryan wants to upgrade his home in 2 to 4 years' time. His current home in Brisbane is worth 1.4 with $500,000 of debt. It's about $900,000 of equity in that property. And he expects that the upgrade will cost around about $2.5 million. So he really wants to spend another mil or 1.1 on the family home within the next 2 to 4 years. He's got a high family income. And he's got a investable surplus cash flow of about $10,000 to $12,000 a month. And so Ryan's question is, what do I do with that money? Should I invest it and try and earn a return? Or should I just put it into the loan and just repay the loan and increase the amount of equity I have in my property? And I should say, Ryan sent me this question in mid-August. So I am about 6 weeks behind, or a little bit more than 6 weeks, in fact. That's why I wanted to record another Q&A episode this week, even though I did one last week. I'll drop in a case study episode maybe once a month from here on in. I just like to get through the questions, and so you can keep them coming because I think they're really interesting. Anyway, going back to Ryan's question. So he's got let's say $12,000 a month to invest for the next 2 years. So if he does that, if he puts $12,000 a month into some sort of investment and earns a 10% return, he'll have $320,000 by the end of that 2-year period, in which case he's earned, in terms of returns, could be income and capital gain, he's earned about $32,000. So, he's increased his money by 10%. It's really not going to change his life. And when we come to these sorts of decisions about, look, I know I want to do something in a pretty finite period of time, in a pretty short period of time. So in Ryan's case, 2 to 4 years. In terms of answering the question, what do I do with the money? We've got to think about what is my upside and what is my downside. So by upside is maybe 10% per annum. I don't know. You could earn more than that. Some markets could really run and it's possible to earn more than that. But if we're going to make an assessment today, I think 10% certainly at the higher end in terms of what assessment I might make. And of course, it's not going to be straight line. Okay, so my upside's 30 grand or so. What's my downside? Well, my downside is if I put in, almost $300,000 into an investment over the next 2 years, my downside is the market drops. And maybe I'll lose 30% of that money. It could be worse. Maybe I'll lose 40% or something like that. So that's the upside and downside. And obviously, over a relatively short period of time, it's possible to lose that amount of money. If you're investing wisely over, say, a 10-year period of time, it's highly unlikely you're probably going to make a capital loss if you're investing wisely, right? So the longer the time period, the more certain we can be about returns. The shorter time period, the more we've got to be concerned about capital losses rather than investment returns. Now, if he puts the money into his home loan instead, the $288,000, so $12,000 a month for the next 24 months, and he's paying 6% or around about that, he'll save about $19,000 in interest. And that is a risk-free return. That is that there's no chance he won't save 19,000. Well, the only chance he will save less than 19 is if his interest rate goes down, of course. So is then 19,000 saving versus, which is going to be after tax, because it's a home loan and the interest is non-deductible, versus $32,000 in terms of returns, but it's going to attract some tax. What's the difference and why would I take that risk? And I wanted to explain it like this just so you can kind of understand the methodology and the approach of which we approach these sorts of questions. Because they're very common. It's very common that someone will come to us and say, look, we've got this money, we want to invest, but we also want to do something in 2 years' time, 3 years' time, whatever it might be. So clearly, Ryan, I don't think it's worth the risk because the upside isn't going to change your life, but the downside, which is a market crash, might make that upgrade a lot more expensive. So I just don't think it's worth the risk of investing that money, even though it might seem a bit boring and conservative. You're probably better off just putting it in your offset account and saving the home loan interest. interest. Now, just as an aside, and looking at your income and all the other details, I would say you've got this plan to upgrade your home within 2 to 4 years. I would say, Ryan, do that upgrade as soon as you possibly can. I mean, very high level, I haven't spent a lot of time on it. It looks affordable today. And even if you go and, if it's possible, go and buy that $2.5 million property and put a tenant in it for the next 2 to 4 years and get the negative gearing benefits, because you are on a high income. So it will give you some tax savings. But what you're doing then is ensuring that price differential between what you want, 2.5, and what you have is 1.4, that gap doesn't widen any further, which it could do if the Brisbane market keeps improving in terms of property price values. So as a general rule, I should say, I typically like to do that home upgrade as soon as I possibly can, because any additional cost as a result of delaying doing the upgrades got to come from after-tax dollars, which is really expensive. But great question, Ryan, and a really good example for me to sort of talk through the approach and when I'm thinking about these sorts of questions. Okay, next question is from Sam. A bit of an interesting one, a bit of a sort of a broad or wide-reaching question, if you like. Sam writes, my question today is, how would you approach receiving inheritance in your late 20s? I know all the standard stuff, pay down debt, invest in education, etc. Is there anything else you would think about? Would love to hear your thoughts on it. Well, Sam, of course, it's going to depend on lots of different things. It's going to depend on the size of the inheritance. If you inherit $10,000 versus $10 million, big difference, of course. It's going to depend on whether that person has any existing assets, late 20s. Probably they're not going to have a huge amount of assets, I would have thought. And then income. So what is that person's income, current income, and what's their future expected income? So it's a really difficult question to answer without obviously some context of both the size of the inheritance and the person that's receiving it. But I think as a general rule or a general observation, if you like, that I could share if I could talk to someone in their late 20s, which would be to take a very long-term view. And I know that's really difficult because often when you're young, there's a lot of uncertainty. You don't know really where you're going to live long-term, if you're going to get married, when you're going to get married, what your income might look like over your working life. There's so many uncertainties. People are just sort of finding their feet to some extent in their late 20s. So that makes it really difficult to make long-term financial decisions. But the flip side is what you want to do is really make a great long-term decision so that whatever someone decides in the late 20s, by the time they get to say 40 or thereabouts, mid-40s, it's actually put them well in advance of their peers compared to, their peers that didn't get an inheritance. Whereas if you took too much of a shorter term focus, you're either going to be too conservative or too aggressive. And that's the problem. Too conservative, you leave the money in the bank. Too aggressive, you go, well, I'll put it all in Bitcoin or something like that. You do something quite speculative because you justify it by saying, well, I'm in my late 20s. I don't have any commitments at this stage. I can afford to take that risk. I think the answer lies somewhere in the midpoint. If that person had, a high level of income or a good level of income that was predictable, I would use that inheritance and I would gear to my eyeballs. Well, of course not. I'm not suggesting you go and borrow, go nuts, but I would try and actually really borrow as much as I possibly can and go and buy a property using the inheritance and my borrowing capacity and buy as high a quality property as I could. I'm going to do an episode about what I'm going to call jumbo property investment. So, most people think, look, an investment property somewhere between $500,000 and maybe 1.5. I think that's probably where 90% of investment transactions occur. Well, I'm going to talk about, I'd like to do an episode about, what if you got $2 or $3 million to spend? How does that look? The other thing you could do is put it into a geared ETF, internally geared ETF like GHHF. That's, if someone didn't have borrowing capacity, but that's something that would play out in the long run. Although I have, you'll note in other episodes I've talked about not potentially putting so much money in a geared ETF when markets are at all-time highs as they currently are. So it's going to depend on the amounts and maybe you spread it across a couple of different options. But difficult question to answer, Sam, because I don't have the background or any details, but that's sort of just my general approach would be try and think as longer term as possible, which tends to be a lot easier, ironically, as you get older. I think, I'm almost 50. I'll be 50 end of this year. I think I'm probably thinking the longest term I have in my life, whereas in my 20s, I was certainly thinking very short term. Okay, next question is from Jared. Jared writes, my wife and I have a self-managed super fund and we've been diligent over the past few years to maximise our concessional contributions. I've been lucky enough to have a high wage from a young age and I've also invested in 3 investment properties, meaning both our super balances will be likely compounding, end up at least 1.9 each, or even more than that with the opportunity to contribute funds from the sale of investment properties as we approach retirement. Can you please explain what happens to any balance above the transfer balance cap, which is the $1.9 million cap, in retirement? Based on the explanation, does it substantially reduce the benefit of diligently maximizing our contributions now versus investing the income that can be utilized prior to retirement? Thanks, Jared. That's a really good question. So Jared's question is, what happens? How's that money taxed, and should I keep putting money into super? Well, the first thing, Jared, you got to think about when you make concessional contributions, you're getting a tax deduction, which means that, so you're saving, well, it depends on what your marginal tax rate is, but if you're on the highest marginal tax rate, you're saving 47%. Now, those contributions are taxed inside super. So if you earn less than $250,000, you'll pay 15% tax inside super. So in that situation, you're 32% better off. And if you earn over 250, you'll pay 30% contribution tax inside super, in which case you're 17% better off. So you're always better off to put money into super. Now let me explain. So the transfer balance cap is the total amount that any individual can have inside super in pension phase that then, as a result, the investment earnings aren't taxed, income or capital gains. If you have a balance between $1.9 and $3 million, that needs to stay in accumulation. So you can only have 1.9 in pension, at least initially when you start the pension. If the pension account then grows beyond that, that's fine. But in terms of capital contribution into that pension account. So if I had $3 million, right, and then I retired tomorrow, I could put 1.9 in a pension, and that's going to be tax-free. And then the 1.1, the remaining amount, would have to stay in accumulation account. As a result, I will pay 15% on income and 10% on any capital gains. So therefore, if let's say that total $3 million balance earned 7% in terms of a total return, I would probably end up paying $11,500 in tax, which is an effective tax rate of 0.4%. So less than 1% in terms of effective tax rate. That's because 1.9 is tax-free, only the earnings on 1.1 would be taxable. So you're still better off. Go hard, Jared, put as much as you can inside super. You're going to get an income tax deduction when you make the contribution. And even when those funds are going to remain there in retirement, they're going to be, not really attract very much tax on the overall balance. Now, the complication is this proposed $3 million cap on super. It's not really a cap, it just changes tax consequences. So for balances that are in excess of $3 million, they're then taxed at 30%, and you're also taxed on unrealized capital gains. It's not law yet, so we haven't done anything about it for clients in our firm. We're not going to until it becomes, or if it becomes law, I should say. But if it does in its current form, it most likely will take any excess of $3 million outside of super, because it's just not worth paying tax on unrealized gains, and we can max out our tax rate at 30% using a company, and we've got complete flexibility over how we use those funds as well. We're always going to get a credit for the amount of tax were paid inside a company. So as it stands today, if that proposed legislation becomes law, Jared, I would say keep contributing into super as long as you're not going to breach that $3 million cap. If you breach the $3 million cap, then you're going to have to do something about it. And, we've got to see what the legislation looks like and whether the legislation has a carve out for people that haven't yet reached retirement but have exceeded that cap. Can they then take the money outside of super? As the law is proposed now, the answer is no, as I understand it. The other thing to think about too when you're inside retirement is what will your individual tax position look like? Because a couple, a husband and wife, or two spouses, whatever it might be, can hold maybe about $500,000 of investments in their personal name, and they're not going to pay much tax, right? Because you can earn about $20,000 a year and not pay very much tax at all. Whereas if you had that $500,000 in super and you'd already fully utilized the transfer balance cap, then you're paying 15% on the income, 10% on capital gains. Look, it's not going to change your life. We're not talking about big numbers here, but it is economical to have some of those assets outside of super. Now, you don't need to worry about it, Jared, because you could still put it all into super and then make that decision when you're retired. You can pull out $500,000 from either the accumulation account, or you'd pull it out from the accumulation rather than the pension, but you can balance that out. But I just thought I'd mention that because it shouldn't just be all super. We'd want to utilize our marginal tax rates in our individual names as well in retirement. And you might be doing that anyway because you said you've got some investment properties. So by that stage, they might be producing taxable gains or taxable income, I should say. Okay, next question is from Steve. Thanks so much for your good feedback, Steve, and all the other questions provided by the previous listeners, I should say, provided great feedback. Always appreciate it. So thank you so much. Steve writes, I've got 2 investment properties which I'm considering selling. I've got one house in Perth and another apartment in Melbourne in Paran. Both were bought using reputable buyers agents firms in each state. Yet despite holding them for more than 10 years each, they've seen very little capital growth, although the Perth one has grown recently. I'm contemplating the decision to sell both properties and put the proceeds into a high growth portfolio within a superannuation wrap structure such as net wealth. As I'm currently a non-resident, I will pay reduced capital gains tax and offset most of the tax by utilising concessional contributions from the past 5 years, unused concessional contribution caps. The properties have performed poorly and there's an opportunity cost of this continuing. I want to put these funds to better use while I'm overseas. This will of course lose the gearing benefit of the property. Can you share your opinion regarding selling these properties to minimise tax to achieve better returns via super? Steve, I don't know how old you are because you didn't put that in the question. If you're a non-Australian tax resident, you can earn dividend income, so returns from managed funds, ETFs, so forth. That's not going to be taxed, and nor will any capital gains. The only thing you're going to pay tax on is interest income, and you'll pay 10% withholding tax. But if you then go and lodge your return, and you've got some negative gearing from property or some other deductions like a concessional contribution, you'll get that 10% back. So would I put it into super? If you went and sold those 2 properties, would I put it into super? Maybe not. I might sort of keep the flexibility not to do that because I'm not going to pay, you're a non-tax resident, you're not going to pay any tax on those assets anyway while you're a non-resident. What we typically do is put it in personal name, and then when the client moves back to Australia and becomes a tax resident again, we'll then move those assets into a family trust. And we can do that without any capital gains tax because there's no unrealised capital gains while they've been a non-resident. Now, this is not advice, of course. This is really just commentary on your situation. But let's go back to the question because it's a good one. I would hate to see you sell either of those properties. Now, I don't know anything about the properties, right? I'll just take it on face value that they're relatively good quality properties in that, put differently, they're not terrible, they're not duds. I see that, there's been no growth, but that's not because there's something wrong with the asset. That's because there's been no growth in the broader markets in those sectors in both those geographical locations. So investment grade apartments, and Paran's a perfect example of this, just haven't grown. They haven't delivered returns. That's not because you made a mistake. That's just because the market hasn't delivered returns, and the same with Perth. So I would hate to see you sell because you've done all the hard work already. You've held the properties for 10 years. My gut feeling is if you went and sold today, that you'll look back in 10 years' time and go, oh, gee, I sold at the bottom of the market, or I sold just before, a growth cycle. Now, the problem as being a non-resident means you aren't entitled to the 50% capital gains tax discount for the number of days that you owned an asset while you were non-resident. That means as a non-resident, when you get some capital growth, you're going to pay the full whack of tax on that growth, no 50% discount. But it's only by number of days, right? So let's assume that you've been a resident for 10 years and now you're a non-resident. Of course, you didn't put that in the question. That's okay. If you hold on for another 5 years, at least only 1/3 of the holding period has been a non-resident. And so at least you're going to get part of that 50% capital gains tax discount. So again, that's something else I think about when non-residents are owning property in Australia. It's very tax heavy from a capital gains perspective, which is problematic. So I think hold on to them. Perth's running now. It'll continue to run probably for many years. In Melbourne, investment grade apartments are completely undervalued. The land value in Paran has absolutely changed over the last 10 years, the underlying land value of that asset. So its technical value is much higher than its market value. And then when you look at replacement cost, the cost to replace that asset, if a developer had to rebuild that asset, it is also well in excess of market value. So all the signs are demonstrating to us that the intrinsic value of that asset is much higher than the market value. It would therefore be a shame to sell it. You don't have to sell it. I'm assuming you don't have to sell it. Now, if you wanted to take an each way bet, what you might do, Steve, is maybe hang on to Perth for another 2 to 3 years and then sell Perth and put that equity into the market or some sort of investment that you're going to earn a return on. Maybe even an internally geared diversified ETF, for instance. So you've got some gearing, but it's not going to attract any Australian tax. And then you've got to hold on to Param for another 10 years. You've got to make that commitment because I've spoken about many times in this podcast, look, Melbourne will kick off at some point. I don't know if that's going to happen in the next 2 years, but certainly I would have a high level of confidence that 10 years from now, that Param apartment is going to be worth materially more than what it's worth today. So that's a long-winded answer there, Steve. But I guess also what it does is show the interaction between tax and financial planning because it's absolutely key. And so you've got to be over the sort of tax rules because it very much integrates with the financial planning outcomes as well. And I think that question is a good illustration, even though maybe lots of listeners aren't necessarily non-Australian tax residents. Okay, next question is from GK, their initials, of course. So GK gives me a bit of background. Essentially, GK owns a dual occupancy property in his self-managed super fund. They bought it for $860,000. The loan's just under $600,000. The property's now worth $1.2 million. The loan against that property, because it's in self-managed super, the interest rate is 7.25% on a principal interest basis, which means the monthly repayments are quite expensive, about $4,100, and they're getting about $4,000 gross from the property in terms of rental. Of course, you're then going to take expenses and so forth away from that. They've got an additional $100,000 of cash, and that's what GK's question is, what are we going to do with the cash? GK thinks, well, we can put it and repay the home because we're saving 7.2%. Actually, for some reason, GK is saying, well, if we gross that up because we're paying 15% tax, the cost of the loan is 8.5%, but actually it's wrong. I'm assuming it's wrong. If the actual interest rate is 7.25%, that is your pre-tax rate. Your after-tax rate is you've got to take off the 15% tax. So it's going to be somewhere 6.5 or something like that. Or he could put the money into the share market. And so, GK, what you're really comparing, because I think you've made a mistake with, grossing up the interest rate by the rate of tax. What you've really got to compare is, okay, you can save 7.25% by making the loan repayment inside super, or alternatively, you could invest that in the share market. And what you got to do is compare pre-tax returns, right? 7.25% is pre-tax. What are you going to earn in the share market? And I would say over long term, you're going to earn more than 7.25%. I probably forgot to mention it, but GK is in his early 40s, and that's pretty relevant actually. So I think in your situation, GK, you're better off to invest that $100,000 than repay the loan. If we think you're in your early 40s, you're not going to access super for another just short of 20 years. So in 20 years, your $600,000 loan, well, it's P&I, so it'll be much lower by then, is not going to be material, even from a dollar value, in today's dollars. A $600,000 loan's probably, if you account for inflation, going to be worth somewhere between $300,000 and $400,000. So your debt isn't a big deal, and you're young enough, you've got a long enough runway, you want to benefit from compounding returns, you want more growth assets, even if that means carrying higher levels of debt. So in that situation, I would invest maybe not all the 100,000 because you probably want to keep a bit of a cash flow buffer in case the property has some issues in terms of maintenance or whatever. But you'd want to invest a reasonable proportion of that amount, I think. The other thing too is I just did some work for a client that had 2 commercial properties inside his self-managed super fund. Now, we have to go and sell one of those commercial properties because we need to start funding pension payments. And that's the problem with property, is it's a liquid asset. And so if all you do is focus over the next few years of repaying the loan, you're not building the liquidity in your self-managed super fund. So we've got to sell one of those 2 commercial properties for this other client. No big deal. That's okay. They've done well. He's in a great position. The other thing though is when we did the projections, he's got to sell sell another one in 20 years' time. And the reason for that is because of the compounding capital growth. Because you've got to draw a minimum pension, and that minimum pension is based on your account balance, and a function of your account balance is the amount of capital growth you're getting from property, is that you have to pay a higher and higher and higher pension. But the problem is you've got less and less and less liquid assets in order to do that. So for this client, he's got to sell another commercial property, actually it's in 15 to 20 years' time. Now, it's a great asset, and if it wasn't for the pension requirements, we wouldn't sell it. So we just got to think really carefully, and it's difficult to do because you don't necessarily have the perspective. I've got that perspective having done that work many times, but you've got to be careful about having illiquid assets inside super. You might be put into a situation where you're sort of forced to sell those assets where you wouldn't otherwise do so. And this client could have avoided doing it if he took a different approach when he was in his 40s. If he's in his 40s and he started accumulating liquid assets, so share market investments, he would have totally avoided that situation. So GK, certainly I think you're going to be better off from a returns perspective. But the main reason I would say get more growth assets or invest that money in the share market is to really build the liquidity in the super fund. The property asset is always still going to be, it's probably its most lumpy asset. You're never going to be able to dilute that, but the more liquidity you can build inside your self-managed super fund, the better off you'll be. Okay, that's it for today. There were some really thought-provoking, interesting questions. I hope you enjoyed them as well. As I like to do, if you send me a question, I'll try and talk about what it was my approach in trying to answer that question rather than just necessarily throwing the answer at you. And what I'm trying to do there is just give you a bit of insight into, how we might attack some of these questions so that if your situation is relatively similar but not perfectly exactly the same as that individual person's, you'll be able to take something away from it. If you enjoy these episodes, please leave a rating or some feedback on the platform that you use to listen to podcasts. So that always helps me. And until tomorrow, bye from now.